The hearing of the Subcommittee on Oversight and Investigations of Financial Services will come to order. Without objection, all members' opening statements will be made a part of the record, and we will recognize as many members who as wish to give an opening statement within limits for up to 5 minutes each. And I'll recognize myself for a brief opening statement just to set the stage. Let me first welcome all the witnesses here. Thank you for being here. As I explained to you before we got into formal session, these hearings normally start at 10 o'clock, but there is a full Financial Services Committee markup this afternoon. And at the time we made the decision to move the hearing up to 9 o'clock to get out of the way of that markup, we actually had 2 panels of witnesses scheduled, which I'll talk about. But so I think members will be here. There is a substantial amount of interest in this subject as reflected by a number of pieces of input that we've gotten in the process. But the 9 o'clock hour for members of Congress is at least for starting hearings, as opposed to going to breakfasts and greeting constituents and doing the other part of the job is a heavy lift. So let me launch into a few comments. Today's hearing is entitled HUD's Proposed RESPA Rule. The Real Estate Settlement Procedures Act of 1974, which we call RESPA, is the federal statute that governs the mortgage settlement process for all Americans. As anyone knows who has ever purchased a home or refinanced a home mortgage, the process involves most Americans' biggest investment and can be intimidating and complicated. Buyers and borrowers must sign dozens of forms and legal documents in one sitting, and quite often they do not understand everything. Sometimes they don't understand anything they are signing. RESPA mandates the disclosure of certain terms, such as a home loan's initial interest rate, prepayment penalties, and settlement costs, among others. RESPA and RESPA disclosures have been the subject of intense controversy and anticipated reform since at least the Reagan administration. The Financial Services Committee has held several hearings on RESPA reform, most recently in the 105th and 108th Congresses. Our colleagues on the Small Business Committee have also held hearings on RESPA reform, most recently in May of this year. RESPA reform continues to generate bipartisan interest, and I thank the ranking member, Representative Gary Miller, for requesting this hearing, and we were happy to accommodate his request. It was a bipartisan outcry and request that we pull people together to discuss this. The reason for today's hearing is to examine the proposed RESPA rule issued by HUD on March 24, 2008 for public comment. At the outset, I should note that over 240 members of Congress signed a Dear Colleague letter to HUD Secretary Steve Preston, urging HUD to withdraw the proposed rule and commence a joint rulemaking with the Federal Reserve Board to produce more simplified mortgage and real estate settlement cost disclosure forms. The letter also warned that the proposed RESPA rule could hinder rather than help the recovery of the housing market, which is of even more concern in light of recent turbulence in the housing market and the government takeover of Fannie Mae and Freddie Mac. Chairman Frank also wrote a letter to HUD Secretary Preston in June, urging HUD to work with the Federal Reserve Board to reconcile inconsistencies between the proposed RESPA rule and the Truth in Lending Act, TILA, disclosure requirements to avoid consumer confusion and redundant disclosures. I ask unanimous consent at this point that the members' letter signed by 240 members to HUD dated August 7, 2008, and Chairman Frank's letter dated June 12, 2008, be made a part of the record. Without objection, that will be done. I was one of the few members of the House who was not a signator to the letter of the over 240 members or to Chairman Frank's letter. And I may be the only remaining member of Congress who can truly be said to be at least publicly neutral on HUD's proposal. So I was glad when our ranking member requested the hearing. I thought it would be fun to see a bipartisan pummeling of a federal government agency and a spirited defense by that agency. I'm always up for a good fiery discussion, if not a brawl. But alas, it's not going to happen, at least not today, because before we could issue our invitation to HUD to come and explain what HUD was thinking, in August, HUD formally sent the proposed RESPA rule to the Office of Management and Budget for review, and now claims that it is obliged not to comment further. So HUD Secretary Preston will not be with us today. That's why we don't have but one hearing panel today. The Federal Reserve also declined to testify, citing a reluctance to be critical of another federal agency in public. I would note, however, that the Fed issued a staff comment letter dated June 13, 2008, expressing some concerns, and I ask unanimous consent to submit that letter for the record. Without objection, that will be done. We are pleased that representatives of virtually every other group in America that I could think of have been lining up at the door to testify, which is why we have so many witnesses on this panel. We have a wide array of witnesses, and we look forward to their testimony. The testimony will be available to HUD and to OMB for whatever use they desire to make of it as we move this process forward. At the end of the day, RESPA reform should be about improving disclosures to consumers so that they can understand their rights and responsibilities when buying a home and avoid unwelcome surprises at the settlement table. While I have never been, and many of you have probably heard me express this view, a big advocate of the benefits claimed by advocates of disclosure, it is certainly true that disclosure helps consumers better understand what they are signing when buying a home or getting a loan. RESPA reform should not unnecessarily confuse consumers, not result in unreasonable regulatory burdens and costs to the real estate industry as the fragile housing market seeks to recover. I welcome the members here. I'm going to be as partial as I can be today. I've fought to maintain this position, not signing on to any of the letters, and I was going to try to be the mediator. I'm not sure there's going to be anybody here to mediate between because having reviewed the statements, it seems to me to be pretty consistent opposition to the proposed rules for one reason or another. So I'm looking forward to building this record, and I'll recognize the ranking member, Representative Gary Miller, who is actually the originator of the idea for this hearing, and we thank him for doing that. Recognize the gentleman for 5 minutes for his opening statement.
Well, thank you, Chairman. It's good to have all of you here today. We're here today because of all of you. Over the years, we've examined some of the RESPA proposals that have occurred in the past that haven't been enacted, and we've all been very concerned. And many of you have come by the office, and we've talked at different functions about your concerns, and I think it's most appropriate that we get those concerns out of the table. We really don't know what it's going to look like when we get the RESPA rule, but what many are hearing, there are a lot of concerns. And I want to say that I have a lot of high regard for Secretary Preston. I think he's a good man, going to try to do a good job. But I think it's also appropriate for us to talk. Our industry, the mortgage industry, is going through incredible upheavals right now. We don't know how bad it's going to get, but we don't want to make it worse. What we don't want to do is, with our U.S. financial markets, experience the upheaval they have to make things more complicated. Record high foreclosures and delinquency rates, bank failures, and Treasury's recent actions with Fannie and Freddie, together with high commodity prices and a suffering labor market, have truly put the U.S. economy to a test that we've never really experienced in recent years. Certainly, the foreclosure crisis has taught us all that we need to improve the mortgage origination process. Revamping these regulations, however, must be done not haphazardly, especially considering the current housing market and the tightening credit situation. Our financial institutions are extremely vulnerable right now. We cannot afford any more large bank failures, and we need to focus on bringing stability in the housing and financial markets. Any reforms must not negatively impact mortgage affordability and availability in the extraordinary environment. Furthermore, some housing experts are predicting that the mortgage losses will reach staggering levels in this coming year. While disclosures must be improved to prevent another mortgage crisis in the future, we must not exacerbate these losses and need to instill some certainty in the marketplace right now. It is important for consumers to understand the terms of their mortgage. Comments from the Federal Reserve Board on HUD's proposal describe how the revised good faith estimate, GFE, is inconsistent and duplicative of TILA's disclosure efforts, which may lead to confusion or consumers disregarding crucial information about their loan terms. The Federal Reserve Board was extremely critical of HUD's proposal and warned that the lack of adequate consumer testing of these disclosures could ultimately hurt rather than help consumers, and I've talked to many of you, and that seems to be your concern also. The board also points out how HUD's failed to incorporate consumer testing results from their study in mortgage disclosure reforms. The Federal Trade Commission, FTC, has also voiced concern with the proposed rule. The FTC has stated that some of the changes may further complicate the mortgage process. The FTC has also advocated a collaborative effort among HUD and the Federal Reserve Board to reform mortgage disclosures. Additionally, 244 members of Congress had concerns with the proposed rule and requested HUD to withdraw the rule and work with the Federal Reserve Board to reform mortgage disclosures. On August 18th, HUD rejected this request and sent the proposed rule to the Office of Management and Budget, OMB, on that very same day. While we are unaware of the provisions that HUD made to the rule, it is important to have a discussion about the effects of the proposed changes. I look forward to listening to the concerns you all are going to bring forward today, and hopefully HUD is listening, at least on the TV, to what we're going to do today. While we would like to have heard from HUD today about this extensive rule to reform mortgage disclosures, they declined our invitation to testify. With that said, as many of you know, Secretary Preston previously served as an effective director of the Small Business Administration. Mr. Preston made important reforms to the administration and understands the needs of America's entrepreneurs, lenders, and small businesses. I believe the Secretary brings great experience to the Department of Housing and Urban Development, and I'm confident that he has taken this issue and your comments seriously with his great consideration reforming the mortgage lending process. You're an incredibly talented bunch of witnesses we have today. You understand your industry and your market, and I'm really looking forward to the testimony, and I thank you for holding this hearing, Mr. Chairman.
Thank you for requesting the hearing. Thank you for your opening statement, and I'm going to go a little bit out of order because I know Mr. Cleaver and Mr. Green have to leave for a meeting that I also need to be at, but I can't attend. So they're going to be my eyes and ears at that meeting. So Mr. Cleaver is recognized for 5 minutes.
Thank you, Mr. Chairman. I won't take 5 minutes. I would like to express appreciation to you and the ranking member for holding this hearing. I am very sorry that the Department of Housing and Urban Development did not send a representative here today and also submit to the questions that we might ask. The proposed rule is a very sensitive issue, and the chairman and others have already expressed their opinions. And to be quite frank, I know people don't normally like to have group projects. People don't like to work together or come together, but I can't come up with any logical reason why there cannot be collaboration between HUD and the Fed. That it is just not practical to say that we can't come to a hearing because federal agencies don't like to contradict one another. Their very existence in many instances is a contradiction to other agencies. And so I'm very interested in hopefully getting back to hear your answers to questions. Ms. Bourne articulated in her statement some things I really would like to get into. And I appreciate the fact that you're coming. I can hope that with all of the various witnesses we have today, that somehow we can get HUD to consider some of the conclusions, suggestions that many of you have reached, and I think, frankly, many of us have already reached. So I look forward to getting back in time to listen to some of your comments or to listen to the answers to some of the questions we raised. Thank you, Mr. Chairman.
Mr. Miller is recognized for a unanimous consent request.
Yes, Mr. Chairman, I'd like to submit the letter from HUD into the record regarding their not testifying today. And I really wish they could have been here at least to testify on what the original RESPA proposal was. We could at least have some questions answered to that. But nevertheless, I asked the UC to submit this letter to the record.
Without objection, the letter will be submitted for the record. Now, lest y'all be concerned that I'm going to pass over Mr. Manzullo, he is not on the subcommittee, and I'm going to personally ask, along with Mr. Miller, that he be given, that we give him unanimous consent to make an opening statement, but I need to let the members of the subcommittee make their opening statements first. So I'll go next to Mr. Green for up to 5 minutes.
Thank you, Mr. Chairman. I especially thank you for holding this hearing, and I thank the ranking member as well. He has demonstrated a willingness to work with us across the aisle in a bipartisan fashion, and I appreciate what he's done to work with me on some other issues. Mr. Chairman, as the ranking member indicated, we don't know what the reform will look like, and I concur. But I also do know this: we must act. We must act. Even when we do act, there are those who contend we haven't acted. I think that the least we can do is make sure that we can have a reasonable retort to those who will contend that we've not done anything and show that we have done something of worth. We understand that knowledge is power, and what we must do is empower the consumer by according the consumer the knowledge necessary to make reasonable, prudent, and judicious decisions. We have some concerns that I think can be addressed. We have two agencies that are charged with the responsibility of dealing with these issues. The Truth in Lending Act directs the Federal Reserve Board to regulate disclosures on loan terms. RESPA directs HUD to do so. These two entities may not harmonize all the time, and as a result, we may not get harmony in terms of what should be accorded the consumer with the disclosure forms. I am concerned about the yield spread premium. The yield spread premium has caused many persons to pay fees that they ordinarily would not have paid had they known they were being accorded these fees. These fees were being placed upon them. There must be some way for the consumer to make an intelligent decision about the yield spread premium. For those who do not know, who may be viewing this, the yield spread premium is a fee that an originator can get when he or she causes a borrower to take out a loan for an interest rate higher than the one the borrower has qualified for. And it need not be disclosed to the borrower that this fee is being charged. The yield spread premium is a concern. It is. We have to have fairness in borrowing such that people know what they are confronting. The initial rate versus the adjusted rate is a concern. Many consumers don't understand this whole notion of a teaser rate and then a rate that will adjust, that they cannot pay for. The adjusted rate has to be made clear to consumers. The prepayment penalties. There are many consumers who don't know that they have prepayment penalties, and when they take out their loans. This is something that we have to make available and known to consumers. And finally, just the cost of the loan. And by the way, I say finally only because I think my time doesn't permit me to go into a multiplicity of other things. But the cost of the loan. There are many consumers who literally, at the time they negotiate their loan, have no idea as to what this loan will cost them. Why? Because consumers are so eager to have a place to call home, especially the first-time home buyer, that they would sign anything. They literally sign documents that have no language on them, and they are told, we will get this back to you at a later time. And they then contend, I didn't sign that with that on it at the later time, and find that that is not going to be justification for having signed the document and the liabilities associated with the document. So I'm very concerned about the consumer. I want the consumer to be empowered with knowledge. We can do this, but I do think that it is going to require bipartisanship, and I think that it's going to require that we have the opportunity to talk to HUD and to the feds about this. I thank you, and I yield back the balance of my time.
Thank the gentleman for his participation. Mr. Lynch is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank the ranking member as well. I'll try to be very brief. I do want to hear from our witnesses this morning. I want to thank all of the panelists here for attending. I would be remiss if I didn't express my disappointment with HUD and with the Fed for their failure to attend. I simply cannot imagine how this helps the American people have any confidence in the fact that our agencies are working with government to address the problems that they face in these extraordinary times when these agencies don't even show up. And while I understand the difficulties there, there should have been some way to send someone here to address the points that the committee and that you on the panel are raising. With that, I just want to point out, I know that Mr. Savitt, your organization, and Mr. Kittle, your organization, are intimately involved in the current difficulties that we are facing, not only on the subprime, but generally. I'll be very keen to hear what you might think we can do to improve the settlement process. And I know that many of the frailties and weaknesses that we see in the mortgage origination process comes from the underwriting side, perhaps. But I do think that the moment of settlement is a time at which some of these weaknesses could be brought to light and the underlying agreement strengthened. So I'd be interested in hearing from you, but also from everyone who has come here this morning to help Congress with its work. So thank you, Mr. Chairman, and I yield back.
Thank the gentleman for his comments, and I join Mr. Miller in asking unanimous consent for permission to allow Mr. Manzullo to give an opening statement. I know he's been active on this issue in the Small Business Committee, so we welcome his opening statement. Gentleman is recognized.
Thank you, Mr. Chairman, for holding this hearing today and for allowing me to testify. I've been a long-time opponent of changes to RESPA. During my time as chairman of the Small Business Committee, I held 2 hearings on the impact of HUD's proposed RESPA changes on small businesses. At both hearings, I was strongly dissatisfied with the lack of knowledge displayed by HUD staff regarding the details of their own proposal and the impact that would have on consumers and businesses. Secretary Jackson testified that there are 8 people working full-time at that department just on the RESPA issue. Their time could be well spent doing something else, such as trying to figure out what to do with this horrible real estate market. In June of this year, I sent a strongly worded comment letter to HUD emphasizing that they have again displayed a serious lack of familiarity with real work experience in the real estate settlement process. I've been involved in over 2,000 real estate closings as a member of the bar for 22 years before I was elected to Congress. And I can tell you, they have no clue as to what happens at a real estate closing, and now they come here with this, again, this ridiculous regulation that could really hurt. I recently met with HUD Secretary Preston, a man I hold in high regard, to discuss these changes. While I see many problems with the current RESPA proposal, I want to mention just a couple of it. First of all, HUD has never complied with the Regulatory Flexibility Act. HUD has never complied with the Regulatory Flexibility Act. Never. The data used here is 6 to 8 years old. It was incomplete back then, it's incomplete now, and they ought to hang their heads in shame over lack of scholarship and coming out with the impacts that this has on small business. And they come back again and again and again with the same old crap. I cannot believe that regulators have nothing else to do than to sit there and destroy small businesses, and now it comes back again. The bundling of services to help out big people and destroy the small businesses under the veiled name of the volume discount. HUD ought to do what its statutory duty is to do. Before RESPA came out, I closed real estate transactions with a one-page form, and everybody knew exactly what the cost of that mortgage was, exactly all of the different costs. Today, more confusion. I would just ask RESPA, ask HUD, just withdraw this thing. Just throw it into the river and get on with something else in your lives. I guess you know where I stand, Chairman.
Thank the gentleman for his comments, and now we've got ourselves fired up here. So I welcome the gentlelady, Ms. Biggert, to the hearing. She's not a member of the subcommittee either, but I ask unanimous consent to allow her an opening statement if she desires to make one.
Thank you, Mr. Chairman. I don't have an opening statement, but I would like to submit for the record a letter that Congressman Ruben Hinojosa and I submitted to OMB about the HUD RESPA and asking them to send it back to HUD and to have further hearings on such a ruling that they've made. So.
I thank the gentlelady for her unanimous consent request, but we have already submitted that letter. That's the one that was co-signed by about 240 members, as I recall, or is there another letter?
Yes, sir.
There's a separate letter. Okay.
This is a future, further letter that was submitted yesterday, and we are getting signatures again on this letter. So,
without objection, that letter will also be submitted for the record. I think we've exhausted all the opening statements now. I told you that there was a great deal of interest in this, and there'll be other members coming in, I'm sure, probably after 10 o'clock. Yeah, there's a conference going on, Republican conference, and some meetings that I'm aware of, so it's a busy day. So let's get to the witnesses. Without objection, all members, other members' opening statements will be made a part of the record. And I will now introduce briefly the members of the panel who will be testifying today. Your full bios and CVs will be made a part of the record, so we're going to abbreviate the introductions. We welcome you here. Our first witness will be Mr. Mark Savitt, President, National Association of Mortgage Brokers. Our second witness will be Mr. David Kittle, President of the Mortgage Bankers Association. Our third witness will be my homeboy, T. Anthony Lindsay from Charlotte, who's here representing the National Association of Realtors, and he's the Chief Executive Officer of Globe Crossing, LLC, diverse real estate company in Charlotte, my hometown. Our fourth witness will be Ms. Margot Sanders, counsel for the National Consumer Law Center, whom I've also had a long and warm relationship going back to North Carolina with. Our fifth witness will be Ms. Rebecca Bowen, the Policy Counsel for the Center for Responsible Lending. Our sixth witness will be Mr. Gary Kermit, President, did I get that right? Kermit? Somewhere in the neighborhood, he says. President of the American Land Title Association. Our next witness after him will be Ms. Deborah Steele, President and Chief Operating Officer, Pulte Management, LLC, and she's speaking on behalf of the National Association of Home Builders. And our final witness today will be Mr. David Stevens, President, Affiliated Businesses, Long and Foster Companies, on behalf of Real Estate Service Providers Council, RESPRO, our most recent addition to this panel.
Pulte Mortgage.
Pulte
Deals with Pulte Mortgage, LLC.
Pulte Mortgage, LLC. Okay, I'm sorry. I'm just trying to rush through this quicker than I. So we welcome all of you. Each one of your statements, written statements that you've submitted, will be made a part of the record in their entirety, and each of you will be recognized for 5 minutes to summarize your opening statement, your statement, and highlight some of the points that you wish to make. There's a lighting system in front of you. It will come on at green at the beginning. At 4 minutes, it will go to yellow, and at 5 minutes, it will go to red. We're not in the habit of being as mean as some chairs are, but we do ask you to respect the fact that there's another demand for this room, and so we ask you to kind of sum up when you get to that red light before we have to ask you to do that. So, Mr. Savitt, you are recognized for 5 minutes for your statement.
Good morning, Chairman Watt, Ranking Member Miller, and members of the subcommittee. I am Mark Savitt, President of the National Association of Mortgage Brokers. In addition to serving as NAM President, I am also a licensed mortgage broker, and like most of my fellow NAM members, I am a small business owner. I would like to thank you for the opportunity to testify here today on HUD's proposed RESPA rule. NAM applauds HUD's response to the current problems in our mortgage markets. We share HUD's resolute commitment to simplify the process of obtaining mortgages and to protect consumers from unnecessarily high settlement costs. However, NAM objects to several elements of the proposal that would not best serve consumers because they would confuse consumers, impede competition, and treat direct competitors differently. In addition, HUD has failed to consider other highly effective and less burdensome alternatives to their proposal. In light of the current market situation, in addition to recent rulemaking and the passage of key legislation, NAM questions the appropriateness of the timing and implementation of HUD's proposal. A significant component of the proposal addresses broker compensation YSP. YSP is already required to be disclosed on the good faith estimate and on the HUD 1 settlement statement for the last 16 years since 1992. The proposal, however, reclassifies this compensation as a credit to the borrower, the practical effect of which will be very confusing to consumers and puts brokers at a competitive disadvantage by imposing uneven disclosure obligations among originators receiving comparable compensation. YSP or its equivalent is present in every origination channel, regardless of whether a broker is involved in the transaction or not. In fact, with the originate-to-distribute model, most originators are merely brokering loans, yet HUD fails to address the converging roles of mortgage originators in its proposal. HUD's proposal addresses broker disclosure in an inequitable manner and in a way that will confuse consumers about the overall cost of a mortgage. This is not simplifying the mortgage process. There needs to be a level playing field for consumers. The proposal relies on testing that was conducted using flawed methodology to assess the value of HUD's proposed disclosures relating to YSP. Additionally, HUD failed to test the disclosures in actual transactions involving competing originators, thereby producing flawed results. Exhaustive studies of mortgage disclosures as detailed in our written testimony issued by the FTC, the Federal Reserve Board, and academic scholars show that broker-only disclosure of YSP creates confusion among consumers and causes them to choose more expensive loans. Additionally, these studies show that broker-only disclosure of YSP leads to bias against broker-assisted transactions and impedes competition, resulting in harm to consumers. Such authoritative research and studies, in addition to consumer testing, led the Federal Reserve to remove broker-only disclosure provisions from its final rule amending Regulation Z of the Truth in Lending Act. NAM has urged HUD to take a similar action with regard to its proposal, and we encourage HUD to work with the Fed to produce an alternative disclosure proposal. One alternative NAM strongly supports is a revised GFE that clearly outlines loan terms and the originator's role in the transaction. NAM has submitted the prototype of such a form to HUD on several occasions. However, HUD has yet to comment on this proposal. Finally, NAM opposes the section of the proposal that would require an addendum to the HUD-1 settlement statement, which would compare loan terms and settlement charges estimated on the good faith to the HUD. Because the addendum or closing script, as it's known, is required to be read out loud by the settlement agent in closing, it will unnecessarily complicate the settlement process, delay closings, and ultimately drive up costs to the consumers. Our mortgage market today is significantly strained, and it continues to experience ongoing turmoil and change. Because of this, NAM believes that consumers in the market in general may be better served if HUD would consider delaying implementation of any new policies or procedures until the market and all market participants have had time to digest the multitude of events already affecting consumers' ability to obtain credit. We also would like to see HUD harmonize its RESPA rule with the Fed's implementation of Reg Z. We look forward to continuing to work with this subcommittee as well with HUD and other regulators on finding solutions that are effective in helping consumers but will not unreasonably disrupt the market or disadvantage competing originators. I thank the committee for allowing me to testify today, and I'd be happy to answer any questions. And Mr. Chairman, I'd like to make one other statement if I could. Mr. Green made a comment, his opening statement, that YSP was not disclosed to consumers, that they basically found this out when they got to closing. YSP, which is disclosed by mortgage brokers, we're the only channel of distribution that actually discloses this indirect compensation. We've been doing this since 1992 on the good faith estimate when the consumer first comes into our office, and once again at the settlement on the closing statement. And most states, such as the states that I'm licensed in, also require 2 state-specific forms. So when a consumer comes into my office, I disclose it 4 times. Thank you.
Thank the gentleman for his testimony, and Mr. Kittle is recognized for 5 minutes.
Chairman Watt, Ranking Member Miller, thank you for the opportunity to appear before you to discuss RESPA, one of the Mortgage Banker Association's top policy issues. I would like to make 3 points, and then I would be happy to answer any questions. First, MBA and I personally are firmly committed to improving the mortgage process for both industry and consumers, and we have been for a very long time. Second, any reforms should give consumers the information they need to effectively shop for loans, to inform themselves about the true cost of closing on a mortgage, and to protect themselves from unscrupulous actors in the mortgage process. That requires a comprehensive approach to the loan application and closing process, involving both HUD's RESPA forms as well as the Federal Reserve's TILA forms. And last, HUD's proposed RESPA reforms do not even come close to achieving simplification. They should be delayed, and officials at HUD should work with the Federal Reserve on a joint and comprehensive effort to simplify and improve forms and disclosures. Improving the mortgage closing and application process will result in better informed customers who understand their loans and the closing process. With greater transparency and better information, consumers can shop more effectively. This will lead to better mortgage decisions, and those lenders who can objectively provide the best products for their customers will be the companies that get the most business. The market will become more efficient. Lenders will have better and happier customers. Reform is right for the market and for consumers. But reform for reform's sake would be quite damaging to the system. Reforms should achieve two interrelated goals. One, help the consumer shop, and two, help them understand their loan and the closing terms better. That's why it is imperative that HUD not work in isolation on this issue, but work with the Federal Reserve in helping consumers shop for and understand their loan. The Fed is responsible for rules implementing the Truth in Lending Act, or TILA. HUD is responsible for RESPA. At the time of the application, borrowers receive a TILA disclosure and a good faith estimate of closing cost. In the middle of the process, recently passed federal law now mandates another TILA disclosure. Then at the closing table, the borrower gets yet another document, the HUD-1, which is different from the previous two documents. All of these documents are ultimately confusing for the consumer. You simply can't compare one document to another without a map. It's so confusing, HUD literally has created a map between the two documents. How is that simplification? Real simplification would look at all of the documents and harmonize them so they can work together. Incredibly, this HUD RESPA proposal would make actual forms less similar. This is exactly what consumers do not need. If you've purchased a home, you have some idea of how a closing process works. Does anybody really believe that the way to fix the closing mess is to make a closing longer and to give more paper to consumers? What HUD has proposed would take what should be a one-page form and turn it into 4 pages. Require a 45-minute script to be read to the consumer, stretching an already long closing process with no benefit to the borrower. And continue to have a series of forms where the lines don't match up and consumers can't figure out what happens from one part of the process to the next. MBA has long supported efforts to make the mortgage process simpler, clearer, and more transparent for consumers. Common sense dictates that HUD and the Fed work together. The rules and forms should be harmonious, work for borrowers, and be implemented at the same time to avoid confusion and unnecessary costs for lenders, sellers, and buyers. In closing, let me say that we all know that the context of this hearing is the larger situation in the mortgage and financial markets. As you know, right now the market is fragile. This is not the time to ask the industry or consumers to assume costs of regulatory changes unless they are necessary and well conceived. We need reform, but we have to make sure we get the right reform. We are pleased that HUD attempted to make a very difficult task. They deserve to be commended for their efforts, but unfortunately, HUD's efforts will not give consumers what they need. Again, I thank you for the opportunity to appear before you, and I look forward to answering your questions.
I thank the gentleman for his testimony, and we'll now go to Mr. Anthony Lindsay on behalf of the National Association of Realtors.
Good morning, Chairman Watt and Ranking Member Miller and the members of the subcommittee. Thank you for holding this hearing and for giving me the opportunity to share the concerns of the National Association of Realtors and its 1.2 million members with the proposed rule to reform the Real Estate Settlement Procedures Act, known as RESPA. Again, my name is T. Anthony Lindsay. I'm the founder and chief executive officer of Globe Crossing Realty in Charlotte, North Carolina. I currently serve as a director on the board of the North Carolina Association of Realtors and a director on the board of governors for the Real Estate and Building Industry Coalition, which serves the metro region of Charlotte, North Carolina. In addition, I owned and operated a residential mortgage brokerage for 6 years. Reform of RESPA is critically important to NAR members simply because it affects almost every home purchase. Since many consumers look to the real estate professional to help them understand the home buying process, the consumer turns to us when they have questions. We clearly recognize the need to reform RESPA and make the process easier to understand. However, we believe that HUD's current RESPA reform proposal falls short of this stated goal. Specifically, we believe that the new good faith estimate and anti-competitive aspects of the rule need further revision. NAR believes the new rule does not simplify the transaction or provide full disclosure. In fact, it will most likely cause confusion, reduce the incentive to shop, and likely raise prices for settlement services in the long run. For example, going from a 2-page GFE to a 4-page GFE does not achieve simplification in our view. The new good faith estimate should mirror the HUD 1 settlement statement, as was suggested by HUD's own design consultants. Marrying these two forms would help consumers understand whether the terms and expenses that were disclosed to them upon loan application are in fact the same ones outlined at closing. Despite its longer length, the new GFE does not include all closing costs, another factor that will contribute to misunderstanding and probably inhibit shopping. NAR, along with the Center for Responsible Lending, has recommended that HUD develop a 1-page summary GFE for shopping purposes and a full GFE matched to the HUD 1 statement that includes all closing costs to help reduce this confusion. We also believe that HUD and the Federal Reserve should coordinate their efforts to revise the RESPA disclosure forms and the Truth in Lending rules as called for by Congress some 12 years ago. HUD must also consider the anti-competitive consequences of the good faith estimate. As proposed, the good faith estimate carries a HUD-required price guarantee only for a lender-provided package of settlement services. As a result, we believe consumers will be less likely to shop for these services, especially when it's pointed out to them that a second GFE would be required if they do shop, and there might be a charge for the second GFE. This point is very important and one that gets little attention in the RESPA debate. The largest financial institutions will likely benefit the most from these new pricing provisions. We anticipate they'll use their market clout and promises of high-volume business to force down prices so they present the lowest cost packages of services and capture market share. Now, on the face of it, that sounds good, and we support the goal of lower cost, but we and many others believe that reduction in prices will only be temporary. In the long run, closing costs will rise and service quality may diminish as smaller lenders and local settlement firms are pushed out of the market. In conclusion, NAR strongly supports better disclosures of mortgage terms and settlement services. HUD's RESPA reform proposal, however, should be reworked to focus on common sense disclosures while eliminating the volume discount, the closing script, and tolerances provisions. Thank you very much, and I'll be happy to address any questions.
I thank you so much for your testimony, and Ms. Margot Saunders, the National Consumer Law Center, is recognized for 5 minutes.
Thank you, Chairman Watt, Mr. Miller, members of the committee. We appreciate the opportunity to speak today on behalf of low-income consumers. The National Consumer Law Center works with lawyers all over the country, legal services and private lawyers, who try to help clients from prevent them from losing their homes. I see hundreds of mortgages every year, and there is no doubt that the current system is broken. RESPA does need reform. We think that HUD's latest proposal is a good way down the road towards positive reform of RESPA. We agree with the members of this panel, however, that more work needs to be done. We hope that the current effort is not suspended, but instead that HUD continues to improve the regulations as recommended and then finalize them. In our lengthy comments to HUD, as well as our testimony, we've provided comprehensive responses to all of the myriad of issues that HUD raises. In the few minutes I have today, I want to focus on just two of those issues. One, the necessity to include the APR, the annual percentage rate, rather than the interest rate in the good faith estimate, and two, the dangers of the proposals on yield spread premiums. HUD is appropriately focused on reducing costs for consumers and facilitating shopping. The APR in the mortgage market is a necessity to achieve those goals. It's the only shopping metric that allows consumers to equate all fees, all potential interest rates over the full term of the loan. We know from research that most consumers do use the APR when they're shopping for mortgages. Interest rates, while reflecting the largest cost of credit, do not reflect other important aspects of credit. In recent years, the marketing of dangerous payment option arms reveals the problem with relying too much on interest rates. The payment option arms are typically advertised, for example, as a 2% fixed rate, even though the rate may be fixed for no more than a day, a month. The APR, while it does not entirely reflect the upwards adjustment in the interest rate, at least reduces the distortion by requiring that the rate be disclosed as a composite rate over the term of the loan. Consumers cannot do the math to determine which of two loans is cheaper given different rates, different fees, and different terms. The APR solves that problem and permits consumers to shop intelligently and efficiently. Yield spread premiums must be substantively regulated. Lender-paid broker compensation, as HUD describes, leads to higher settlement costs and higher interest costs. Generally, borrowers receive little, if any, benefit from lender-paid broker compensation. Worse, lender-paid broker compensation appears to drive racially disparate pricing. Only where the fees are either all in or all out of the rate are consumers able to shop successfully for the cheapest loan. When consumers can compare loans with the fees all in or all out, they are comparing a limited number of variables. On the one hand is a loan with a particular rate and all fees required to be paid by the borrower, either in cash or out of the home equity of their loan. On the other hand is the same loan with all of the fees paid by the lender, but from the interest rate. No additional cash or equities required. This is a no-cost loan. There are multiple benefits for no-cost loans, including the retention of precious cash and equity, as well as the lesser-known finding that no-cost loans result in significant reduction of all closing costs. However, the key to achieving this reduction is that the lender has to pay all the fees. There cannot be a mix. The use of the combination of payments has the opposite effect, and the studies routinely find that the combination of payments result in a higher total of closing costs. Most disclosure of lender-paid broker compensations are likely to confuse consumers because the trade-offs are so complex, and because borrowers are led to believe erroneously that brokers are acting as their agents. We share HUD's concerns that a separate agreement is likely to confuse borrowers. We agree that the impact of any permissible yield spread premium must be clearly disclosed on the GFE. However, HUD's use of the term credit to describe lender-paid broker compensation in the absence of substantive regulation that limits total fees is terribly misleading. The key point is disclosure alone is not sufficient. Yield spread premiums should be prohibited unless all other fees are folded into the interest rate and no discount points are charged. Additionally, no other lender-paid broker's compensation should be permitted if the borrower is making any direct payments to the broker. Thank you. I'll be happy to answer any questions.
Thank you so much for your testimony. Ms. Rebecca Bourne, on behalf of the Center for Responsible Lending, is recognized for 5 minutes.
Good morning, Chairman Watt, Ranking Member Miller, and members of the subcommittee. Thank you for inviting me to testify today about RESPA. I am Policy Counsel at the Center for Responsible Lending, a not-for-profit, nonpartisan research and policy organization dedicated to protecting home ownership and family wealth. We are an affiliate of Self-Help, a lender that makes responsible, fixed-rate mortgage loans to people with blemished or non-traditional credit. We first wish to congratulate HUD for its efforts to improve RESPA. Confusing and misleading information has contributed to this foreclosure crisis. However, we cannot overemphasize that poor disclosure has not been the driver of this crisis and that improving disclosure will not prevent future predatory lending. This crisis was primarily caused by lenders and brokers selling unsustainable loans, largely in response to secondary market demand. Only substantive laws will prevent predatory practices, realign incentives, and ultimately restore health to the mortgage market. HUD, through RESPA, has the authority to eliminate one of the key culprits of the subprime crisis, abusive yield spread premiums. In designing RESPA, Congress adopted not only disclosure provisions, but also substantive ones, aimed to prevent anti-competitive conduct that makes mortgages unnecessarily more expensive. As has already been noted today, yield spread premiums, or YSPs, are payments from lenders to brokers in exchange for the broker selling the borrower a loan with a higher interest rate than the borrower qualifies for. RESPA has long prohibited payments for simply delivering a loan with a higher interest rate, calling these kickbacks. HUD has said, though, that since consumers can use YSPs to buy down upfront origination costs, they deliver value and are not prohibited. But in reality, particularly in the subprime market, this trade-off of rate and upfront costs rarely, if ever, occurred. Consumers unknowingly paid YSPs and earned no corresponding reduction in upfront costs. The single most effective action HUD could take to protect consumers through RESPA is to refine its policy position to allow YSPs only when they result in a corresponding reduction in upfront costs. This would help reform the subprime market without significantly impacting the prime market. In its proposed rule, HUD attempted to address YSPs through its origination cost disclosure on the good faith estimate. However, the disclosure will not ensure the price trade-off between YSPs and upfront costs. This shortcoming does not represent a failure on the part of the disclosure as much as it reflects the impossibility of ensuring a price trade-off without substantive reform. If we are going to try to rely on disclosure alone, the proposed disclosure should be much improved. We understand that in designing the disclosure, HUD attempted to treat lenders and brokers even-handedly. However, we don't think HUD should do so at the expense of a more comprehensible disclosure that better alerts consumers to the risky nature of YSPs, especially considering that our most recent research shows that borrowers pay significantly more for subprime loans originated by independent brokers versus retail lenders, and HUD's own recent study of FHA loans was consistent with our findings. Our testimony and our comments to HUD on the proposed rule include several specific recommended improvements to the origination cost disclosure. With respect to GFE provisions more generally, HUD and the Federal Reserve should coordinate to develop one integrated disclosure form. Short of this, we have made several recommendations for how HUD should improve its GFE so that it better alerts consumers to the riskiest features of their loans. Critically, HUD should require that terms be binding for 30 days instead of 10, and it must provide an interest rate lock of at least 10 days to prevent common bait and switch tactics. Finally, we strongly support HUD's request that Congress enhance RESPA's civil penalties and equitable relief. We further request that Congress add a private right of action for all elements of RESPA, especially the GFE and the HUD-1. The lack of a private right of action has meant that abuse often carries no consequences, in which case even the most perfectly designed disclosure will not help consumers. Thank you again for this opportunity to testify today, and I look forward to your questions.
Thank you for your testimony, Ms. Bourne, and Mr. Gary Kermit, President of American Land Title Association, is recognized for 5 minutes.
Thank you. Chairman Watt, Ranking Member Miller, and members of the subcommittee, thank you for the opportunity to testify on HUD's proposal to amend RESPA. I would also like to thank Representatives Hinojosa and Biggert and all the members who signed the Dear Colleague letter that was sent to HUD. As the 2008 president of the American Land Title Association, I am speaking on behalf of our 3,000 title insurance companies, agents, abstractors, escrow officers, and attorneys who search, examine, insure land titles, and perform real estate closings. A majority of our members are small businesses with fewer than 20 employees. As we are all painfully aware, the real estate market is experiencing a downturn of historic proportions. The recent federal takeover of Fannie Mae and Freddie Mac, the bankruptcy filing yesterday of Lehman Brothers, are just the latest examples of the severe stress in the housing and financial markets. Although we all agree with the goal of increasing transparency and simplifying the transaction, HUD's rule does not do so. It would add increased new regulatory burdens on the industry and confusing, lengthy disclosures to homebuyers. In the current environment, it would make things worse. My remarks today will focus on 4 areas of the rule that would be most harmful for our members and homebuyers. First, the closing script. The closing script should be eliminated from the rule. Why? First of all, it's too late at the closing for a homebuyer to change the terms of the loan. In some cases, the moving van is parked outside. Second, the settlement agent doesn't have the information or knowledge to answer questions raised by the closing script. Third, the increased costs for longer closings will fall on the homebuyer. And finally, in some states, it would violate unauthorized practice of law statutes. Another point that HUD fails to recognize is that over 50% of closings occur at the end of the month. The increased time to draft, read, and explain the closing script will harm smaller settlement companies because they lack the resources to add personnel and physical space to accommodate these extended closings. Second, title and closing fee disclosures. The disclosure of title and closing fees on the proposed forms is misleading and will discourage shopping by homebuyers for the services that are in their best interest. Why? Because the new GFE only discloses an aggregate figure for a range of services. That makes it more difficult for the consumer to shop for individual services at a lower price. They won't know what's in the so-called package. Similarly, by lumping together so many different charges into the category of primary title services on the new HUD 1, the buyer and seller will not know how their funds were actually dispersed and to which providers. This defeats a primary purpose of the HUD 1 as a record of the transaction. This will also hide what fees the seller may have negotiated or be required to pay under state law, practice, or contract. Title and closing fees should all be itemized on both the GFE and the HUD 1 to encourage shopping. Third, volume discounts and tolerances. As proposed by HUD, the allowance of volume discounts will be impractical, anti-competitive, and will harm small title insurance companies, small banks, mortgage brokers, appraisers, and other small settlement businesses. It is, in fact, a disguised form of packaging that was uniformly rejected in 2002. The largest companies have the resources to either favor their own affiliated companies or to create a network of preferred providers that can offer services at or below cost. This will push small independent providers out of business, resulting over time in less competition and higher prices. Our members do not believe that HUD should dictate such changes. The tolerance provisions will inhibit shopping. The message from the lender to the borrower will be, go with my recommendations, you will get a better deal. Yet there is no guarantee that these recommended service providers are the least expensive or the best. Again, this will discourage shopping. And then finally, the proposed forms are confusing. They create more problems for the home buyer than they solve. They are very confusing. For example, as it's been mentioned by my panel colleagues, the proposed GFE would differ from TILA in its treatment of interest rates. Also, by characterizing the yield spread premium as a credit to home buyers will be very, very confusing. In conclusion, ALTA recommends that HUD limit its efforts to simplifying only the GFE and the HUD 1 so that comparisons can be easily made between the documents. ALTA, along with the National Association of Realtors and the Center for Responsible Lending, have worked together to develop new GFE and HUD 1 forms that are clear and more transparent than both the existing and the proposed HUD forms. This would be a huge improvement for home buyers without imposing extraordinary costs on our small business members. Thank you.
Thank you for your testimony, and I'll try to get this right this time. Ms. Deborah Steele, President, Chief Operating Officer, Pulte Mortgage, LLC, on behalf of the National Association of Home Builders. You're recognized for 5 minutes.
Thank you very much. Chairman Watt, Ranking Member Miller, and members of the subcommittee, on behalf of the 235,000 members of the National Association of Home Builders, thank you for holding this hearing and the opportunity to share our concerns regarding HUD's proposed RESPA changes. My name is Deborah Still. I'm President and CEO of Pulte Mortgage, a subsidiary of Pulte Homes, one of the nation's largest home builders with operations in 26 states. My comments today focus on HUD's proposed definition of required use, which would prohibit a home builder from offering incentives in exchange for a buyer's use of the affiliated mortgage or title company. Our position is that HUD's proposed definition will have an immediate negative impact on the efficient operations of home builders and the majority of consumers buying new homes, and that HUD has not established a sound rationale for this change. Most home buyers need a loan to buy a home, and this financing is a critical part of the home buying process. Home builders create affiliates to ensure that the financing is ready when the home is complete and to enhance the customer's overall home buying experience. Any home that fails to close on time hurts the builder in the form of financial and reputational costs and creates a hardship for the buyer. With aligned processes, affiliates consistently outperform outside lenders in executing timely closings because outside firms are simply not prepared to deal with the complexities of new construction lending, which can and do include frequent last-minute construction change orders. In addition, an affiliate is committed to the high value a builder places on customer satisfaction because the builder relies on its customers for repeat and referral business. According to a recent study by J.D. Power and Associates, also cited in HUD's regulatory impact analysis, the majority of borrowers surveyed who financed through a builder affiliate were more satisfied with the financing experience and chose the builder affiliate because its interest rates were competitive and the entire buying process was easier. Moreover, customer service from an affiliate means more accurate moving cost estimates and the certainty that the borrowers understand their loan programs. Customer service is a long-term view for an affiliate because they focus, along with the builder, on creating communities and enhancing the builder's brand. We don't just do one-off transactions. Contrary to HUD's view, timely closings and extraordinary customer service are the primary reasons are the primary business value affiliates provide to home builders, benefits to the consumer that far outweigh the income the builders receive from the affiliate ownership. Affiliate relationships have facilitated home purchases for upwards of millions of consumers over the last several decades. In the market conditions of the past year, as mortgage financing has become unstable and uncertain, affiliate relationships have assumed even a greater importance. Many home builders can document hundreds of sales originally scheduled for outside lender financing that have fallen through and were subsequently saved by the builder-affiliated mortgage and title company. Never more than now are reliable service, accurate forecasting, and competitive pricing offered by affiliates needed by home builders and their buyers. In truth, affiliates allow builders to manage the business of building and selling homes with greater efficiency, the benefits of which translate into value for the buyer. HUD's proposal fails to account for the savings builders realize through affiliated businesses, which are then passed on to the consumers as incentives. Contrary to HUD's assertion, home builders do not increase the selling prices of homes to offset these incentives. The competitiveness of the marketplace does not allow it. Beyond the negative impact to builders and home buyers, we do not believe HUD has established a sound rationale for changing the definition of required use. HUD supports its proposal entirely based on anecdotal, incomplete, and unsubstantiated examples which have been advanced by previously outspoken competitors of affiliated businesses. The problems cited by HUD appear to be violations under the current RESPA regulations and should be addressed as such, but they do not make a case for change. Furthermore, HUD has provided no empirical studies or statistics substantiating its position that consumers are harmed by the use of builder affiliate service providers. We suggest that in developing this proposal, HUD's research does not conform to the data quality requirements imposed in all federal rulemaking. In closing, I will reemphasize that prohibiting affiliated incentives would ultimately increase home purchase costs, undermine critical financing support to the consumer at this time of unprecedented turmoil in our industry. As further detailed in my written statement, NAHB has offered an alternative definition of required use, which, if adopted, would continue to permit home builders to offer bona fide and reasonable incentives in exchange for buyers' use of affiliated companies. Mr. Chairman, thank you for this opportunity to share our views and those of the National Association of Home Builders. I would welcome any questions.
Thank you so much for your testimony. Mr. David Stevens, President, Affiliated Businesses, Long and Foster Companies, on behalf of Real Estate Service Providers Council, RESPA.
Good morning, Chairman Watt.
For 5 minutes.
Thank you. Good morning, Chairman Watt, Ranking Member Miller, members of the subcommittee. Thank you for the opportunity to speak here today. Long and Foster Companies is the third largest residential real estate brokerage firm in the nation, with over 200 residential real estate brokerage offices in the 8-state Mid-Atlantic region. We offer a full array of mortgage, title, and insurance services through a combination of either wholly owned or partly owned businesses. Today I'm representing RESPRO, a national nonprofit association of over 200 companies who promote diversified services for home buyers, often called one-stop shopping. I share the concerns of my fellow witnesses have expressed today in their testimony over the potential impact of HUD's proposed RESPA rule on these individual industries. I'm here today, however, to address the particular impact that the required use provision of the proposed rule will have on diversified real estate brokerage firms and our customers. The majority of the nation's 500 largest real estate brokerage firms offer mortgage, title, or closing services. According to a 2008 survey of home buyers by Harris Interactive, 45% of home buyers chose a one-stop shopping service in 2008 compared to 2002. In today's challenging housing market, which has seen the failure of numerous mortgage and title firms that can threaten prompt and efficient closings, diversified real estate brokerage firms are increasingly using our affiliated companies to enable our real estate customers to close on time. Because we own companies needed to close the home purchase transaction, we are better able to resolve any service issues that arise more efficiently than we could with independent companies. RESPA prohibits from requiring the use of an affiliated provider. HUD has long allowed voluntary incentives to consumers who purchase affiliated services as long as the services are separately available and as long as the incentive is not offset by increased prices of other services in the transaction. Because diversified real estate brokerage firms can assure more prompt and efficient closing through our affiliated companies, we commonly offer voluntary positive incentives to consumers who use our affiliated services under this long-standing RESPA exemption. For example, we offered our real estate customers who purchased a mortgage through our affiliated mortgage company, Prosperity Mortgage, a 0.5% reduction in their mortgage over the first year, which using a rate of 6% saved them $762 on a $200,000 mortgage. The program is voluntary, and if it wasn't used, the home buyer paid no more. But if it was used, the customers would have received substantial savings, and we would be better able to assure they get to closing on time. I've described many other examples of consumer incentives used in our industry in my written statement. These voluntary consumer incentives have been well received by consumers. In fact, Harris Interactive found in its 2008 survey that I referred to earlier that 77% of home buyers considered the biggest advantage of using one-stop shopping programs is saving money through discounted prices. Unfortunately, HUD has proposed in its RESPA rule to prohibit companies from offering these consumer incentives that lower costs and enable prompt and efficient closings. HUD has provided no indication that it has analyzed the types of consumer incentive programs being offered throughout the industry today that provide consumers tangible savings and better service. Mr. Chairman and members of the subcommittee, HUD's proposed ban on voluntary consumer incentives is another example of how HUD's proposed RESPA rule would increase costs and result in poorer service for home buyers. The rule was not well conceived as a whole. Given the breadth of HUD's proposed RESPA rule and its potential impact on today's fragile housing market, we believe that HUD should withdraw its RESPA regulation and work with the Federal Reserve Board to develop uniform mortgage disclosures that would truly accomplish its goals in rulemaking. Thank you for the opportunity to testify, and I would be glad to answer any questions.
Thank you for your testimony. Thank all of the witnesses for their testimony and for being very timely. Almost everybody came in right at the 5-minute or under the 5-minute in some cases, and we appreciate that. We welcome Mr. Royce, who's a member of the subcommittee, Mr. Perlmutter, who's a member of the subcommittee, and Mr. Hinojosa, who is not a member of the subcommittee.
Mr. Chairman, may I just correct something that I said about the letter?
Gentlelady is recognized.
Thank you. The letter that I referred to that was being sent to OMB from members, Representative Hinojosa and I and others, has not been sent yet. It will be very soon. I had said that it had been sent yesterday. I didn't want people to think that they didn't receive it.
We will make that exception and or clarification and modify the unanimous consent request to insert into the record the final letter when it is sent, because the record will still be open at that point. I welcome Mr. Hinojosa, who is not on the subcommittee, and I would ask unanimous consent at this point that Ms. Biggert and Mr. Hinojosa, who are not members of the subcommittee, be allowed to engage in the questioning of witnesses at the end of the subcommittee members' questions. Without objection, it is so ordered. Both of them have a very, very strong interest in this issue. In fact, they both led the letter that was sent to HUD originally, and obviously are leading a subsequent letter that's going to OMB now. So they have strong feelings about this and strong knowledge about it also. We thank the witnesses for being here and covering a wide range of issues related to the proposed rule. There is some differences of opinion within the panel. I thought it would be just a consistent flogging of HUD, but we may have some interesting interchanges within the panel also. I'm going to now recognize members of the subcommittee and subsequently members who are not on the subcommittee but are members of the full committee to ask questions, each for 5 minutes. I will defer my questions to the very end to allow other members to go in case they need to leave. And I will start with Mr. Lynch. He's recognized for 5 minutes.
Well, thank you, Mr. Chairman and the ranking member. I appreciate the testimony that's been offered this morning. Let me say at the outset that I share much of your concern regarding the HUD proposed rule, and however, with that much being said, I do want to caution, a number of you this morning have talked about the cost of regulation, and I just want to remind you of the cost of no regulation. As we know, much of this subprime mortgage crisis came out of a process that was completely unregulated with respect to mortgage brokers. The no-document loans, the no-document mortgages, the liar loans, the liar mortgages, all of that went out the door without substantial regulation as compared to banks. And I think there was an outsized representation of those bad mortgages originated by mortgage brokers as opposed to banks that were more heavily regulated and overseen. I'm not saying there was no regulation. I'm just saying there was less regulation of our mortgage brokers. So when I hear that we don't need additional regulation of the mortgage brokerage industry, it's sort of like the captain of the Titanic saying we don't need more lifeboats and making the statement from the deck of the Titanic, because we are obviously having a very difficult time. I thought, Mr. Kermit, your observation that if you're trying to correct these weaknesses at the closing, it's a bit too late. I've done enough. I've been the victim of enough closings, I should say, to know that there's only so much you can accomplish on that day at that moment. You got 8 people at the table, and 7 of them are being paid only if the closing goes through. So and it's a very difficult situation to try to sort of catch the runaway horse at that point. So I agree with that very succinct observation. However, given the fix that we're in, and I understand that the HUD proposal has many weaknesses in it, and I understand that there's a disparity between where HUD is going and where the Fed has gone with respect to the Truth in Lending Act. And it's almost apples and oranges when you look at the 2 proposals and the 2 approaches by both those agencies. And I'm going to ask Mr. Savitt and Mr. Kittle to have a first whack at this, since I've mentioned them in my opening remarks. Do you think we should try to reconcile the approaches by HUD and by the Fed with respect to the Truth in Lending language, or do you think that we should go back to scratch on both and try to, rather than harmonize the 2 existing proposals, just go back to square one and try this all over again?
Mr. Lynch, first I want to, if you don't mind, I'd like to address one of the comments that you made about...
I expect that, yes.
Okay. About the subprime. First of all, mortgage brokers are regulated in every state in this country in the District of Columbia. As a matter of fact, in some cases, we're more regulated than other originators, loan officers that work in banks, for example. But most importantly, dealing with the subprime issue, mortgage brokers did not develop the loan products. They did not develop subprime products.
Fair enough.
We didn't set the guidelines. We don't underwrite, and we don't originate those loans. We sold the loans that were created by others. So I think to characterize mortgage brokers as the ones that caused the problem with subprime loans, I think is a little...
Well, no, I think I conceded in my opening statement. I said I realize a lot of the weaknesses and frailties are in the underwriting process.
Right.
However, and again, there's involvement by the broker, there's involvement by the rating agency that gave it a AAA rating. There were failings all along the line.
Right. Plus,
I'm just trying to give you a share.
I appreciate it. Plus, there was a GA. Thank you. We've taken more than our share, trust me.
Probably.
There was a GAO study that was commissioned by Chairman Frank and Ranking Member Spencer Bacchus. And that GAO study, the purpose of that study was to show what happened with the mortgage meltdown, with the housing crisis in this country, and particularly if mortgage brokers were the culprits. And mortgage brokers were vindicated within that study. One other study by Georgetown University showed that by using a mortgage broker for a subprime loan, that a consumer would save on average 1.13% on their annual percentage rate. So I thought it was important to bring that out. But as far as your question about HUD and the Fed, I think it's important that they do harmonize. I think that would solve a lot of the problems.
Okay. Thank you, sir. Mr. Kittle.
Mr. Lynch, thanks for the question. May I also open with just a quick
Oh,
comment?
absolutely.
Okay. I'm sure you expect it.
Yes, sir.
Is that it is not, and we will defend this statement and can, it's not necessarily the products that caused the problem. They were made to the wrong people, because 85% of those products are still paying on time at the end of the day. So I just want to make that point clear, that the cause for foreclosure, and we're not here talking about that, but we are talking about the issues. The 3 top causes are unemployment, divorce, and health care. They weren't the products themselves. But to answer your question, we do think that it is time for the Fed and HUD to sit down together. HUD mentions through its own, it states through its own actions, the documents that I held up during my 5-minute testimony, that it's so confusing that they have to make a map to explain to the consumer. So this is onerous, it's over the top. I'm going on my 31st year in this business, and when I got in the business back in the 70s, I had to disclose truth in lending and calculate it at the application by hand. I didn't have computers. We didn't have PDFs and cell phones. We had to calculate it out. Part of the issue is the education process. We put information in a computer and it spits our forms out. The people taking the loan applications need to be educated on the forms they're giving to the consumer. So we advocate not only for pulling this RESPA law, but we advocate also for education of the people that are taking the loan applications.
All right. Mr. Chairman, I yield back.
Thank the gentleman. The ranking member, Mr. Miller, is recognized for 5 minutes.
Thank you. I took the cost of regulation a little different than my good friend Mr. Lynch did. I took you meaning the cost of inconsistent regulation was what I took in your statements. And I agree the cost of inconsistent regulation can have a very negative impact on the marketplace. Mr. Lindsay, you had said that small lenders will be pushed out of the marketplace based on this regulation. Can you further elaborate on that, please?
Thank you, Ranking Member Miller. The concern that we have is that the way that the regulation is proposed right now, it would offer an opportunity for the larger lenders to put forth a package of guaranteed services, and that would, in fact, allow them to use their market clout to press down the prices, which ultimately will lead to smaller lenders or smaller service providers being anti-competitive and perhaps even having to cut back on the services that they provide in order to meet those prices that they would be required for them to be included in these packages. So if they're not included in the package, they have lesser opportunity to present themselves to the marketplace, and invariably, they will probably be pushed out of the market.
Thank you. Ms. Stills, you said there'd be an immediate negative impact on the marketplace. Can you further elaborate on that?
Well, certainly a negative impact on the efficient operations of the home builders. Definitely a negative impact on the consumer. If you look at the value of the incentive, that which is offered by the builder and is a reflection of the builder's benefits, we take the economic value certainly away from the consumer. We would also take away from the consumer the ability, if you will, to understand the value that a builder affiliate brings in its years of expertise in a new construction environment. New construction lending is different than lending in an existing environment. We would not be able to appropriately demonstrate to the consumer the efficiencies that we could create through the coordination of affiliates, the commitment to customer satisfaction, and the long-term view. We do not believe as mortgage affiliates we do transactions. We build communities. We want our communities to perform. We want our communities to perform 1 year, 2 years, 3 years down the road. We sell lifestyle. And so we take great care in making sure that our buyers understand the loan programs that they are choosing, make sure they understand their total move-in cost estimates, make sure there's no surprises at the closing table.
It seems to be a common complaint that you hear among people who are buying that they were given an estimate, and when the closing process occurs, all of a sudden things start to pop up. And I know HUD's tried to deal with that through their proposal. Somebody very close to me, it happened to them where they got the good faith estimate and they had a lock-in date on their rate, so they had with 3 days to close or they're going to lose their rate. And all of a sudden some points and fees start to appear that they weren't expecting, which really can't do. And HUD tried to fix it. If you don't agree with the rule, how would you think that could be better handled? Yes, Mr. Kittle.
Well, we've proposed to HUD a very simple one-page GFE and a new HUD 1. They've had it for almost a year.
It's the same as basically the upfront good faith estimate?
Right, but the difference is all the lines match. Yeah. You can't, I mean, that's real rocket science. You can't have predatory lending until you lend, which is what you're saying. So when a consumer goes to closing, whether it's first-time home buyer, somebody that's bought 20 houses, elderly, minority, if all the lines match, then you can't change fees and points. And if you do at that point, the customer always has the right to back away from the table.
And clarify the statement, you're not arguing against regulation. You want consistent regulation is the biggest concern I heard from all of you when we met.
Well, let me go to Deborah Still's point in her testimony, which was a great point, and we all need to take it away today, is that there's a lot of regulation on the books right now, a lot of laws, and they're not being enforced by HUD. Maybe we should enforce what is there. Regulation is great as long as it's not onerous, and it doesn't add cost to the consumer.
And everybody understands what it is.
Everybody understands it. It's clear and transparent.
Okay, now the Federal Reserve Board's comments on the proposed RESPA rule discuss how the HUD and Fed should harmonize TILA and RESPA. The disclosure, they discuss how the different disclosures are duplicative and inconsistent. Would you agree with these comments, and how would you ensure consumers receive disclosure in a comprehensive manner, and how would consumers react to multiple disclosures? And whoever would like to answer that one. It's a three-part question. Take anyone. Yes, Ms. Savitt?
Mr. Miller, as we know, in addition to the Fed, the Federal Trade Commission has also weighed in on this with two studies from 2004 and 2007. The 2007 study was even more extensive than 2004, and it talked about these different types of disclosures, that they were too complicated, there were too many of them, and that we needed to simplify this process for the consumer. And they even came up with some other type of, in addition to the Fed having some ideas of how to disclose, the Federal Trade Commission also came out with their own forms. So I think what we really need to have here is the Federal Trade Commission, the Fed, and HUD sit down. I know it would be unprecedented, but if the three of them would sit down and harmonize their forms together, and I know we're adding one more into the mix here with the FTC, but I think if we did that and we listened to the one agency that is charged with protecting the consumer, that being the FTC, I think we would have the right forms for the consumer. There probably would be less forms, but the right forms for the consumer that would make it easier for them to understand the transaction, thereby avoiding problems when they got to closing.
I agree with that. The HUD's proposing to address this in a booklet form. I mean, do you think people are really going to take the time to review the booklet to try to comprehend inconsistent loan terms? Yes, Mrs. Stills.
Yeah, I might mention, using an example from my company, we conduct a disclosure conference call 1 week after loan application, and it is to provide the customer in assisted fashion to go through all of the disclosures that they have to sign even today. And as an independent mortgage bank with state disclosures as well as federal disclosures, today it's a 45-minute phone call. On average, it takes 45 minutes to make sure that the borrower truly understands the initial truth in lending disclosure, the good faith estimate, and all of the state disclosures. We've got to have a comprehensive approach for federal disclosures, or that call's just going to get longer.
Dr. Stevens?
It's interesting, and you referred to, Mr. Miller, and having recently had a friend who closed a mortgage, and the surprises at the settlement table prior to that with things changing. Between the deed of trust and the promissory note, all the disclosures, I really question today how deep a consumer goes into each one of those documents. We provide every consumer a glossary of terms, which is actually prepared by HUD, that we present to our consumers so they understand what kind of mortgage product they're getting. The challenge that we see, if you go through the actual good faith estimate document, I can't see anything that will confuse a consumer more than this new document that would be added to the additional documents they get already. So while we all agree that we need to come up with better ways to disclose mortgage products, particularly option arms and the kind of things that cause so much trouble over the last 24 months particularly, this will just do nothing more but confuse. As a matter of fact, I don't even think it explains the ARM very well in the questions it asks, and I think consumers will walk away just with more confusion.
Well, I want to thank you all for your comments. They've been very productive, and I appreciate it very much.
Thank the gentleman for his questions. Mr. Perlmutter is recognized for 5 minutes.
Thanks, Mr. Chairman, and thank you, Mr. Miller, for convening this panel. And I just want to thank the panel members here, because you guys all know your stuff. We've sort of been on the downside of the market, and everybody's in, kind of emergency mode here. But I just appreciate this. I want to tell you the framework I'm coming from. First, with respect to RESPA, we're dealing with the biggest transaction in somebody's life, or in most people's lives, and that's the purchase of a home. So we start there. Now, how we got to this panel today, I'd say there was a lot of money chasing a lot of transactions, a lot of loans. And so as time went on, the products got riskier because the borrowers became less creditworthy, in my opinion, just having been sitting up here for a long time and listening to these kinds of things. Mr. Stevens, and here's really the dilemma I have, and that all of you have, and that is convenience versus sort of confidence, or could potentially confusion, but convenience of the transaction versus confidence in the price of the different, other than just the purchase price, but the price of all the ancillary services. Or I think maybe it was you, Ms. Bourne, that said this, but it's comprehensive versus comprehensible. The more comprehensive it is, given the myriad of products that we have now, the more incomprehensible this form's going to be, or the least useful the form is going to be. So there are a lot of things up in the air, and so let's get back to basics. What's the purpose of the good faith estimate? Let's start with you, Mr. Kittle. You've been through the wars on this thing. What is the purpose?
Well, the purpose is, at the loan application, to disclose to the customer in good faith that these are their costs that they're going to incur for the purchase of their home. And it's called a good faith estimate because those costs can change under certain circumstances. If the house doesn't appraise that they're buying, they may have to go back and renegotiate the price, therefore it changes. If they, during the process, decide that they may want to change loan programs, a whole new disclosure has to be made and then redisclosed with a new good faith estimate. So there are situations when things change. That's why it is an estimate of cost. Plus, there are two things on there that we don't know for sure at the loan application. That is when the loan's going to close, so we have to estimate the amount of daily interest they pay from closing date to the first of the next month, and the estimated property taxes. The title search hasn't been done yet. We need to make sure that those things are accurate. So many of the costs on the GFE are exactly what we know. There are some that can change. So when we go to closing, we need a HUD-1 settlement statement that matches up line for line. Each one of these lines are numbered. Why shouldn't they match up? And that's a rhetorical question. So when the customer goes to closing, they can say, oh, you said it was going to be $300 for an appraisal. Why is it $375? Or you said my interest rate was X. Why has it changed?
No, I'm with you 100%.
Right.
And these forms,
but
because
that's
there
why
are
we
so
have
many
a good
forms,
faith estimate.
make it very complicated for the borrower. But on the other hand, you've got this myriad of products. Now, maybe I'm living in antiquity, but I thought these forms were the result of a fear of tying arrangements, of anti-competitive combinations between the real estate brokerage firm and the mortgage company and the home builder.
We've had a good faith estimate before we had RESPA laws.
Okay, but I thought RESPA, which is what okay, so you answered as to good faith estimate. Let's talk about RESPA. I thought now with respect to RESPA, which is the intention to try to modify RESPA a little bit, or these good faith forms, how do we take into effect then this, or should we just get rid of sort of this fear of tying arrangements?
No, we just want, and I'll finish this and turn it over to Mr. Savin. What we're advocating is, one, the Federal Reserve, and HUD to sit down together and work this thing out. Not only do we need a GFE that's clear, that matches the HUD one, let's get it all done at the same time and get TILA reform also. The most confusing form at loan closing and application is the truth in lending. The 4 blocks across the top, the APR disclosure. That's the most confusing form. The one where predatory lending can happen is not the TILA, though. It's when you get to closing and costs have changed on the HUD one from the good faith estimate.
Okay.
You match lines with numbers, it makes it harder for it to have predatory lending and change the fees and costs.
And then Mr. Savitt, and then I'd like Mr. Lindsay to talk about, because I guess my concern is, do we need to worry about tying arrangements and any of that in these forms? Because that, from my experience, that was one of the key pieces of it all.
Well, first thing I'd like to say is that I agree with Mr. Kittle about the one-page disclosure of the good faith estimate. There's a soundbite for you.
Thank you.
And the problem that we have well, let me just address this. Some of my colleagues here today spoke about the required use section in RESPA. This is something that I know quite a bit about. I have been researching this for the past 4 years based upon complaints that I first received from my customers, and then also working directly with HUD. The number one complaint that HUD has, according to HUD, are complaints over affiliated business arrangements. Now, affiliated business arrangements are not bad. We're not advocating outlawing them. They are required. These companies are allowed, builders, for example, and the mortgage companies are allowed to offer a discount to the consumers, provided it is a true discount, and it is not made up anywhere else in the transaction. And we're fine with that. The problem comes in under the tying arrangement, as you mentioned, Mr. Perlmutter, where you have a builder who offers perhaps a $5,000 assistance towards closing costs, maybe an upgraded kitchen, a swimming pool. We've seen cars. We've seen all kinds of things. But it's contingent upon the required use of a specific settlement provider, namely a mortgage company and a title company. And what we have found is that in many cases, the interest rates charged in the beginning or the interest rates disclosed on the good faith estimate in the beginning are not what happens or not what materializes when you get to closing, because you're not locking in the interest rate when you first file your application with the builder in many cases, because houses usually take 4 to 6 months to complete. So what happens is when you get down towards the end, maybe 30 days out, when they give you the interest rate, at that point, the interest rate is substantially higher in the majority of the cases. So if you try and get out of the transaction to use an outside lender, the first thing they tell you is you're not getting your $5,000 towards closing costs. We gave you an upgraded kitchen at a cost of $20,000. You need to write me a check for $20,000, and if you don't do that, you're in violation of your contract. We're going to void your contract and keep your earnest money deposit. So there is a major problem with tying arrangements.
All right, my time has expired, and maybe the chairman will allow another pass through the panel, but I appreciate
Well, I
your
think
answers.
Mr. Stevens at least wants to respond, so
There's
we'll
just-
give him equal time to
Thank
respond.
you, Mr. Chairman Watt. There's just two minor points I'd like to make sure we have on the table. One is that the current RESPA law requires that these tying arrangements, that affiliated business arrangements must be disclosed to the consumer, which we do up front in our industry. And there's a separate disclosure. For example, if you use a long and foster agent to buy a home and you use the affiliated businesses, that disclosure is all clearly provided to the consumer at time of real estate contract submission, not at the end. So that's already covered in the RESPA provision. That's one key point. The other thing I'd just like to add is in the written statement that I provided all of you, I gave examples in that statement of some discounts that we have used. Those are true subsidies. We lost revenue on those provisions that we provided to consumers. They're typically short-lived, but they were consumer benefits, and it was only through the value proposition of being able to have a full-service real estate company that has all of these services together that we could, in essence, do that. But it was a direct benefit to the consumer. It was less revenue than we would have realized on the transaction, and less, we believe, than competitors could provide on that transaction unless they offer the same kind of discount. It's a direct consumer benefit, and that's the key point I also would like to add. Thanks.
Mr. Perlman, can I add one thing, clarify my statement? What I was speaking of is tying of incentives to the required use of a specific service provider. I'm not talking about the disclosure, the affiliated business arrangement disclosure. Thank you.
Thank the gentleman for his questions. Mr. Hinojosa is recognized for 5 minutes for questions.
Thank you, Mr. Chairman. First of all, I wish to thank Congresswoman Judy Biggert for joining me to lead the effort to try to bring us to the point that we're having this congressional hearing, which Chairman Watts has helped us bring before Congress. I found the testimony given by each one of you very informative, and I believe that we make the case for what we were trying to do in the letters that took place August the 7th, August the 18th, and May the 5th between HUD and now the next letter that will be going to OMB. But I want to ask that you raise your hand if any of you know the content of the revised RESPA proposal as submitted to OMB. Not one of you. Mr. Chairman, I think that we need to know that this process has not been what it should have been in order to have something that is good for those borrowing monies for home mortgages, nor the lenders. I ask another question. Do you agree that OMB should reject the revised RESPA proposal and send it back to HUD with instructions to reopen it for a 60-day comment period and work with the Federal Reserve as it revisits the Truth in Lending Act. Raise your hand if you're in favor of that. Thank you. Well, I want to say that I wish to express my appreciation to you for holding this important and timely hearing on a flawed, misguided, and seemingly mysterious proposal by the Department of Housing and Urban Development to amend the Real Estate Settlement Procedures Act, commonly known as RESPA. I ask for unanimous consent that my entire statement be included in the hearing today. Thank you. I also want to take some excerpts from this because I want to make some points. I believe that it's the responsibility of members of Congress who sit on this increasingly important committee to ensure that HUD does not alter RESPA to the detriment of consumers, the home buying process, and ultimately the economy of the United States, which relied so heavily in the recent past on the strength of the housing market to sustain itself. I believe it was on May 5th that Congresswoman Judy Biggert and I sent a letter to HUD's Deputy Secretary Roy Bernardi requesting that the HUD extend the comment period on the proposed RESPA rule change by 60 days, and all they gave us was 30-day extension. I got that phone call directly from the Secretary. On August the 7th, Congresswoman Biggert and I sent a letter to HUD addressed to Stephen Preston, Secretary of HUD, and that letter requested that HUD withdraw its flawed proposed RESPA rule and immediately commence a joint rulemaking process with the Federal Reserve Board to produce more simplified mortgage and real estate settlement cost disclosure forms. On August the 18th, HUD hand-delivered a document that they claim to this day is the response from the Secretary of HUD to me and to Congresswoman Biggert and the other 242 members. It is important for the record to show that the Secretary of HUD apparently did not have the time nor the inclination to respond to a letter signed by 244 members of Congress. Instead, he had his Assistant Secretary for Governmental Affairs author and sign the document, which was the response we got. I thought that was insulting, not only to Judy and to me, but I believe to the other 242 members of Congress who co-signed the letter. Now, let's look at what we think is the next step. No one other than HUD and OMB knows the content of HUD's revised RESPA proposal. I think its revised proposal needs to be vetted by consumers, by industry, and by members of Congress. Now that the revised RESPA proposal has been submitted, OMB may take one of three actions. 1, reject the revised proposed rule. 2, send it back to HUD to be published in the Federal Register as final. Or 3, return the revised proposal to HUD with instructions. Judy made points earlier today that we had co-signed a letter to OMB requesting that they reject the revised RESPA proposal and send it back to HUD with instructions to coordinate with the Board of Governors of the Federal Reserve, as well as other relevant federal agencies, and we will be sending it out today. Chairman Watt, HUD received almost 12,000 letters opposing its proposed rule. 244 members of Congress signed a letter to HUD requesting that it withdraw its proposal and commence a joint rulemaking with the Federal Reserve Board as it revisits the Truth in Lending Act. All of this to say, OMB should send the revised RESPA proposal to HUD with instructions, is what I recommend. I ask unanimous consent that copies of these 3 letters that I've been making reference to, dated August the 7th to Honorable Stephen Preston, Secretary of HUD, August 18th letter to Judy Biggert and to me, which was the answer that I referred to by the assistant to Congressional Affairs, Assistant to the Secretary for Congressional Affairs. And the third one is dated May the 5th, which we sent to the Honorable Roy Bernardi, Deputy Secretary. And I ask unanimous consent that they be included in today's record.
Without objection, it may be that all or parts of those have already been submitted for the record prior to your coming in, but to the extent that you're unanimous.
I discussed it with Judy, and we were both in agreement to submit them in their entirety.
We will make sure that they're in the record
full.
in their entirety.
Mr. Chairman, right here. If I could, I just want to commend the congressman, say well done, and Congresswoman Biggert, thank you for getting that done. Well done.
I have one last question before I conclude. I think that the mess that we're in, the subprime mortgage loans contributed to the crisis we face in home construction today. But let's look at the possibility, and I want somebody to answer this. What would be the impact of the proposal that the adjustable rate mortgage for home loans be prohibited for a period of not less than 5 years? Could somebody answer that? What would be the impact? Yes.
So I understand the question. You would prohibit all adjustable rate mortgages for up to 5 years?
It's been a mess.
Is that the question?
It was explained in one of our hearings that there were people who could possibly use it to buy a house and flip it in a short period of time. But it made a mess out of the situation that we have today. And my question to you is, there are lots of options available for me or anyone else to borrow money and be able to buy a home. If you were to take ARM from one of those options, what would be the consequences? Because I certainly am prepared to take the action to take congressional action and ban that from the list, at least for 5 years, so that we can see if we can straighten out the mess that we have.
I think that would be an action that we would be totally against. I think it would be inappropriate for this reason. Adjustable rate mortgages, when given to the right customer with the right caps and margin disclosures, are an effective tool. Back in the early 2000s, 2001, 2003, they were actually as much as 35% of the loan production that was out there. They represented 35% of the business. They weren't subprime ARMs. They were good, solid 3151 adjustable rate mortgages that were sold to the GSEs and private investors. They are an effective tool. They're not the ones that are delinquent. You can flip a house regardless of a program that you take. You can flip a house on a 30-year mortgage, so it doesn't make any difference whether it's an ARM, a pay option ARM, an FHA loan, or one that goes to Fannie or Freddie. So I think that is confusing the difference between flipping and an adjustable rate mortgage. So we think that it would hurt business, and it would hurt. FHA has a great program right now, Congress.
Let me ask Rebecca.
One-year ARM that would
Fine,
hurt first-time
I understand everything you said. I want to ask Rebecca Bourne, as representing the Center for Responsible Lending.
For many years, adjustable rate mortgages have been made and underwritten responsibly, and they didn't create the crisis that we've seen today. Far more responsible for the crisis has been the 228 and 327 teaser rate loans, where consumers were sold super low rates for anywhere from 2 years to, in payment option ARMs, their rate may last as long as 1 day. Those were toxic products, and they were not properly underwritten. Borrowers' ability to repay was not properly assessed in many cases. So I think that we would be more likely to recommend an approach that addressed proper underwriting standards and addressed some of the broader perverse incentives in the market, from the secondary market all the way down to the broker imposing assignee liability, before we would recommend banning all ARMs for a 5-year period. Thank you, Chairman Watt.
I thank, gentlemen, and to the extent that members of the panel have additional responses to this question, you're welcome to submit them in writing. It's really not the focus of this particular hearing, but I didn't want to cut off discussion of that issue. It's a novel idea, and I suspect everybody on the panel would be uniformly opposed to it in its breadth, at least, even though those who have some concerns about the way adjustable rate mortgages have had impacts in the marketplace. Mr. Manzullo is recognized for 5 minutes.
Thank you, Mr. Chairman. When I practiced law and was involved in at least a couple thousand closings, it was apparent to me that the more people that are involved in closing, the more the consumer is protected. We found that through the analysis of taking a look at the closing statements as we would get figures into the title companies, the attorneys involved, the realtors, the bank. And there was always that backup that you had an independent set of third eyes that would take a look at the closing statement. I've got a question to Mr. Kermit and Mr. Lindsay. In your testimonies, you discussed your organization's opposition to so-called volume discounting. These are the big guys. I believe volume discounting is a veiled attempt to reintroduce the concept of bundling services. In the hearings we had when I chaired the Small Business Committee in 2003, the long-term impact of volume discounts is to eliminate competition and destroy small businesses. However, HUD has indicated that people who have never been to a real estate closing except perhaps their own, then they brought in a lawyer. HUD has indicated they feel that volume discounts are not a repeat of bundling. I'd like to ask you if you agree with that assessment. Can you discuss the impact that volume discounting would have on title companies and other small businesses and also on the realtor profession?
Yes, thank you for that question. We agree with your assessment. The members of the American Land Title Association, we have both large companies and small companies, but we're uniformly against HUD mandating or encouraging volume discounts. On the one hand, it's hard to argue against lower prices for consumers, but to mandate it or to pave the way for larger companies to have a competitive advantage is not the way to do that. In fact, volume discounts would be discriminatory. It would discriminate against smaller companies who don't have the relationships with large volume lenders, so they can't offer a volume discount, and would also discriminate against consumers who are not dealing with a lender who has that network of service providers. For instance,
Mr. Lindsay, why don't you pick it up? I don't want to run out of time, then we can come back.
Well,
Go ahead.
I concur with what Mr. Kermit said thus far, and I think what we'd like to add to this, though, is that there's also the component of value. And at the local level, for example, real estate professionals have relationships with smaller vendors and smaller providers who provide value and who are more accustomed to the local practices and customs in that particular marketplace that have real applicability to the transactions. And if we're allowed to suppress the pricing so that those local providers are unable to compete and therefore are then pushed away, then we eliminate the choice option that they have. We also will expose ourselves to the potential of a reduced set of value that's actually being delivered. And ultimately, when it's all said and done and all the dust clears, there's a strong likelihood that prices are going to go up again because we've reduced competition.
What has always bothered me about HUD and the fact that the people who draw this up have no real estate experience is that they come out with the outrageous statement that a consumer will save $1,000 at closing if bundling is allowed. They've never been able to answer that question of what cloud they picked that from. Plus, my understanding is that I take a look at this 4-page monster and the other one called TILA, I guess TILA the HUD, if that's what you want to call it, is the fact that the real estate closings, when I closed them, would take a half an hour. When my wife and I bought a townhouse out here in 1996, it took 3 hours. We were told not to bring our kids with us, and I had to hire an attorney to go through those documents, even with the vast experience that I have. Now HUD, again, has made it even messier. But my understanding, as I look at those documents, if there's a kickback arrangement between a lender and a real estate company, that does not have to be disclosed if the bundling takes place. Isn't that correct?
That's our understanding as well. And I think we also have a further concern that when, in fact, this bundling occurs, that we don't have a breakout of the actual services that are involved. And so sometimes you might have a person show up at closing, and there's a charge on there which they had no knowledge of in advance of that.
You mean the so-called document fee?
Yeah, or commitment fee, or so many other fees that are that would be allowed to be included. And just recently looking at this settlement statement and comparing it to the GFE, for example, the title charges are not broken out. And there are a number of title charges that would be discrete and shown on the existing HUD-1 settlement statement that are now being combined. And those include attorney fees in some states that are attorney closing states, like North Carolina, for example, where there's no place on that good faith estimate for an attorney's charge for settlement services. So this bundling of things is really just obfuscating the process further, and we think actually complicating it more and making it less simple.
So they create the problem with the bundling, and then they come up with a disclosure that does not show where any misuse or abuse would take place in that. I had a good friend bought a piece of real estate, very large real estate company, and they, of course, had their own mortgage company. He ended up with 2 closings because of the war that broke out, because he did not want to use their lender. And I guess he finally told him that you know, I could pick my own lender. Don't force me to go with your lender. No one talks about that coercion that takes place with the consumer, and that's why I think the consumer groups ought to be out fighting this bundling, because any time you have a relationship, as some people are starting to itch out there, and you should, anytime you have a close relationship between a real estate firm and a so-called preferred lender, that does not help out the consumer, because so oftentimes the consumer simply talked into it. It does not have the opportunity to shop on it. I'm not saying that the rate may not be more competitive. It may be, but it just puts more pressure on the consumer. Thank you, Mr. Chairman.
Mr. Chairman, may I make a comment?
Mr. Stevens, I think, wanted to respond to your last comment, so we'll give him that opportunity.
Thank you. Again, just 2 reminders that we'd always like to make sure that we emphasize it when this discussion comes up. First of all, the required use provision exists in the existing RESPA law, so you cannot require the use of an affiliated business as part of the real estate transaction. That's prohibited today. The law is in effect. It's been so for 16 years. So that does exist. I think you make a great point. I'd like to look at the other side. In August of 2007, one of the largest home lenders in America out of New York failed. And we were presented with hundreds of transactions at Long & Foster that could not settle in the subsequent days and weeks that had been committed to, locked, and approved by this lender. And only by having our own companies in-house, where we control the process, could back up our commitments, could we make sure those transactions closed. It saved literally hundreds, and I'd be glad to submit the actual number for record during that period, and that was literally from just one institution.
Well,
in New York.
that was okay in that crisis, but in Oregon, Illinois, a town of 3,500, and throughout the country, the power of the largeness, as it were, of your organization could actually hurt the other people. That's what they're concerned about.
Could hurt other people in what way?
Well, because of the bundling, that you go into an area and you have a whole panoply you have your appraisers, you have your surveyors, the so-called one-stop shop. Mm-hmm. That's really the job of the realtor. Because I've seen realtors, right, Mr. Rensley, realtors go out there and they fight for their client to get the best rates on mortgages, to find the people that have the best reputations in the individual trades. And as these people come together, they don't have intertangling interests. They're there looking out for the consumer because the consumer hires them directly. And my concern is, this is just in general terms, is that the more you bundle these services to make it so-called easier for the consumer, the more likelihood there is that mischief could take place to the little people that don't have the opportunity to be as large as you are. And again, That's not an accusation. That's just a general statement. Thank you.
Ms. Steele?
I would just only point out that the difference between a true discount and offering an incentive of value is different than bundling services and not accounting for those services.
I thank the gentleman for his questions. I think the time has come for me finally to ask some questions, and I will yield myself 5 minutes. My philosophy at these hearings is to try to get as much into the record of varying opinions as we can, not to pit people against each other, but I think it's helpful to hear all sides of an issue. And by and large, everybody has been uniformly opposed to HUD's proposed regulation in some respect. So that's a consistent thread. But there are some potential inconsistencies in the panel that I'd like to explore just a little bit. Ms. Steele and Mr. Stevens strongly advocated I guess it's an affiliate service issue. I'd like to get on the record Ms. Saunders and Ms. Bourne's perspective, if your organizations have a perspective on the affiliate service position, just so we have, we've seen some indications of the conflict with Mr. Manzullo's questioning, but Ms. Saunders, Ms. Bourne, do you have, do your organizations have positions on this issue?
Yes, but it's short and sweet. If, to the extent that an affiliate is required, we think that the total cost of the loan, not just the services provided by the affiliate, need to be disclosed and reduced, which is, I think, goes to many of the comments that we've heard today. The critical point is that consumers, when they're buying a house or obtaining a mortgage, very rarely shop on settlements, shop for specific settlement services. They shop for the total cost of the loan. It doesn't matter to them which particular provider they use. It matters how much money they have to come up with, how much money their extra loan, the loan is going to be extra because of these closing costs, and what's the cost of the loan.
Ms. Bourne.
We agree with the National Consumer Law Center on that. We would only add that we do support HUD's clarification of the definition of required use to where a referred provider, using a preferred provider, should not produce an incentive or disincentive for the overall cost of the loan for consumers.
Okay, I wasn't trying to create a counterpoint. I just wanted to make sure that we have in the record everybody's perspective on it, if there are varying perspectives on the panel. The second issue is, did you have something you wanted to add to this point, Mr. Lindsay? Go ahead.
Yes, if I may, Chairman. The one point that we've sort of glossed over is that the enforcement of this is really one of the critical components of this. We don't find there's a really big problem with having affiliated relationships, provided we have enforcement that weeds out the bad actors. You know, there was a very good example that Mr. Stevens gave where there is really a substantial difference between cost and price here. And if a vendor is able to reduce costs and therefore pass that along through an arrangement where there's an affiliation, we don't find that to be a disadvantage to the consumer necessarily. But what we do need to do is to weed out the bad actors. So enforcement needs to be really beefed up, I think.
And if I could just go on
Ms.
record.
Steele, I think, is about to agree with you.
Yeah, if I could just go on record and absolutely agree with Mr. Lindsay that, you know, there is current regulation. Current regulation would, if enforced, would weed out the bad apples, and we wouldn't be throwing the baby out with the bathwater for the real value that affiliates offer the consumer.
Mr. Kittle, quickly though, because I got one other conflict that I want to clear up here.
Is that, you know, you already have to disclose the affiliated business arrangement. That's disclosed, so I agree. But we're also required to give an approved provider list in addition to that, which lists several that closing services that the consumer can choose from. It was rightly said, most of them don't choose to go anyplace else other than what is recommended in 99% of the cases. So we already give an approved provider list in addition to the affiliated business arrangement.
I agree. Most people don't look. In fact, I'm just kind of in the position right now. I'm refinancing. If I were refinancing in Charlotte, where I live, I know all of the providers, the title companies, the lawyers, the lenders, the brokers. I mean, I'd be shopping this thing to death. But closing a refinance of a condo here in Washington, I know none of the providers. And so when I was offered the opportunity to just turn that over to somebody, it seemed like a good idea because I wasn't going to go take the time to shop around on this thing. So, I mean, I think it differs from market to market. Mr. Savitt, on this point.
You know, again, it's not the disclosure. I think everybody does disclose properly. The problem here is the carrot that is dangled in front of the consumer. If you use our settlement service providers, you will receive a discount or an incentive. But if you don't use our service providers, you won't get the same discount. So, you know, this is the problem. They're being coerced into using these specific settlement service providers, and it's not always the best deal. As a matter of fact, the majority of the time, it's actually more expensive.
See, I thought this was the least controversial of the subjects. The second issue that I wanted to see whether there was a way to reconcile was the opposing positions of Ms. Saunders and Ms. Bourne, and Mr. Kittle and Mr. Lindsay and Mr. Savitt, I believe, probably, on this whole YSP. Is there a way to reconcile you all's positions, or you all just, I take it that one side would like to just do away with yield spread premiums or some such. Tell me how this can be reconciled. Mr. Savitt first, Mr. Kittle, whoever else wants to weigh in, and then we're going to end this.
Well, the first thing I think we need to do is keep in mind the consumer here. This is all about the consumer. We have to level the playing field for consumer. We all talk about occasionally leveling the playing fields for ourselves. We have to level it for the consumer. And the way to do that is all originators, regardless of how they're licensed, should be required to disclose all of their direct and indirect compensation. Everybody discloses in the exact same form or on the exact same forms in the exact same manner. This is what the FTC was talking about, because by making only brokers disclose their indirect compensation, and we know everybody gets it. Matter of fact, that was addressed in 3915. You know, everybody gets it. So let's be fair to the consumer. Let's have everybody disclose all of their indirect compensation in the exact same manner on the exact same forms, and then the consumer has a fighting chance.
Mr. Kittle.
Where we respectfully disagree with Mark and his group is, number one, yield spread premium disclosure is something that should remain. I think it's wrong to say, as was stated earlier, that every time you use yield spread premium or broker, that it results in higher costs to the consumer. That is absolutely wrong. The individual loan officer company can set its own benchmark based on the price it receives from the lender, and they can determine to take less, and in many cases do in a competitive market, and reduce their cost and advertise an even lower rate with YSP. But as far as our difference here is, we think that it should be disclosed. People who are lenders, like myself, are larger members at the Mortgage Bankers Association, can't disclose what they're making on a loan in many cases.
Do you think the other cost ought to also be disclosed? If you're going to disclose yield spread premium for brokers, are there other internal costs, if there's not an outside broker, that also ought to be disclosed?
I think everything should be transparent, but where they're asking us to do and have this, quote, level playing field, if I'm going to hedge my loan, if I'm going to portfolio that loan, or hold it on my warehouse line, I can't tell you what I'm making on it the day I close, whereas when a broker closes the loan, their total compensation is received at that moment on the spot.
Okay, I think the bottom line here is pretty much the same bottom line we got to on the other issue, if these things are done responsibly and they are disclosed and the buyer, consumer, borrower understands what's going on and it is of some benefit, then there's some value here. Is that a fair summary, Ms. Saunders?
Not quite, Mr.
Okay.
Chairman.
Well, give me a fair summary then.
We think disclosure in this instance is not sufficient. HUD clearly has, under its statutory authority, the authority to substantively regulate yield spread premiums. And we think that they should explicitly say yield spread premiums are legal only when they are the sole source of payment of the broker and all other fees.
Now, can they do that in this rulemaking RESPA process, or should that be a separate issue from the RESPA reform?
HUD has chosen in the years and years that it has been working on this effort to deal with yield spread premiums. The consumer groups have consistently said, both in the discussions, ongoing private and public discussions, and in our comments, that yield spread premium regulation needs to be substantive. There's no reason why that substantive regulation cannot be included in this rulemaking. Okay. It's part of RESPA. It's Section 2607 of RESPA.
Mr. Savitt, last word on this point.
Okay, a couple of things. And,
I'm way over my time.
I've been saying this for a few years, and it used to be a joke, but maybe it's not a joke anymore. Maybe we should rename RESPA, Require Everyone Show Profits Act. Mortgage brokers have been disclosing for 16 years everything they make, and we don't have a problem with that, but we think in order to be fair to the consumer, everybody should do it. Lenders know exactly what they're going to make on a loan, and I think it's also, as to what Ms. Saunders said, it's allowable if all of the closing costs are included. Well, shouldn't this be the consumer's choice, whether they want to include all or part of their closing costs? We're taking choice away from the consumer if we follow her line of thinking.
My time has long since expired, and so I'm going to treat you all the same way on this issue as I did Mr. Hinojosa. To the extent we would welcome follow-up comments, written comments on this issue. I think these are the two major issues, really, where inside the panel there are disagreements. Generally speaking, the common thread through the panel was we don't like RESPA's rule in one respect or another, not always for the same reasons, but there was uniform opposition to immediate promulgation and finalization of a rule. But on these two issues, we have some internal disputes in the panel. Mr. Cleaver is recognized for 5 minutes.
Thank you, Mr. Chairman. In fear that I would ask questions that have already been asked, I would just express appreciation to the panel, and I have surveyed your written comments. Thank you very much. If any of you have influence over HUD, would you exercise it? Thank you.
The gentleman yields back his time, and I would say to the gentleman and to all members that members may have additional questions for this panel which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and to place their responses in the record. It's been a wonderful hearing. The breadth of and knowledge about this issue has been very impressive. The exact kind of input that we need in the legislative process. At this moment, this is outside the legislative process, but we reserve the right to pull it back in if it becomes necessary, and this might be an important predicate for doing that. Let me do a couple of housekeeping things. I ask unanimous consent to submit for the record the following items. HUD's proposed rule that was issued in 73 Federal Register 14030 to 14061 dated March 14, 2008. Number 2, the proposed good faith estimate form. Number 3, the existing good faith estimate form. Number 4, an undated response letter to Representatives Hinojosa and Bigot from Sheila Greenwood. I think Mr. Hinojosa's unanimous consent request probably covered that. Number 8, a statement for the record from the Independent Community Bankers of America, dated September 16, 2008. I don't know how they didn't get on this panel, but they're probably mad at me, but I'll make it up to them. Number 9, the next, a statement for the record from the National Credit Reporting Association, dated September 16, 2008.
I'd like to submit for the record a statement by Michelle Bachmann.
Statement dated September 16, 2008 from Representative Michelle Bachmann. Without objection, those items will be submitted for the record. Let me thank once again all of the witnesses for being here today to testify. It was a wonderful hearing, and the hearing is adjourned.
Thank you much.
Got your mic off there.